Something major just happened and most people didn't even blink. The Federal Reserve quietly announced that it is done shrinking its balance sheet and soon it will begin expanding it. They packaged it as a technical adjustment, something that people don't really need to worry about. But if you understand market cycles and you understand how debt systems evolve, then you know exactly what this moment is. The Fed has shifted from draining liquidity to adding liquidity. But hang on, they are doing this while the economy is running hot. And that's the part that changes everything. So today we'll be diving into Ray Dalio's recent article that highlights the Fed is stimulating into a bubble, as well as some of the overall concepts from his book, How Countries Go Broke. Billionaire investor Ray Dalio has warned about this. So today we're going to be looking at some of his ideas and concepts that he's written about. And let's look at history to find out what happens when the Fed stimulates into a bubble. So when the Fed injects money into a system during a crisis, we all know what that is. That's rescue mode, stabilization, emergency response. But this time, there seems to be no emergency because stocks are still elevated. You look at many indicators such as the Buffett indicator that shows that stock market valuations are at all-time highs. Inflation hasn't fully cooled off. Consumers are still spending and unemployment is historically low. So why would the Fed start expanding its balance sheet again? That's because the government's appetite for borrowing has steadily increased and investors are not buying long-term bonds. This means that the central bank is stepping in to fill the void. Many investors that come on the show talk about the bond market is something that you should actually watch. And thinking about the bond market, this is the moment where monetary policy becomes less about controlling inflation and more about funding the government's debt machine. Ray Dalio and many other investors, scholars, and historians have researched this and have linked this to historical behavior. So this is the same pattern that we've seen whenever debt reaches unsustainable levels. The government needs more money than the market wants to lend. The central bank steps in as the buyer of last resort. Liquidity increases even when the economy is not weak. Asset prices spike because money has nowhere else to go. And eventually inflation reignites and the central bank is forced to tighten into a bubble. This is how late stage debt cycles behave every time. And it has to do with mathematics. So what happens when you add liquidity into an already hot market? Let's think of the economy as a fire. When the fire is dying, adding extra firewood or fuel makes sense because you're trying to keep the fire alive. Now imagine the fire already blazing. What would happen if you throw gasoline onto that fire? Fire gets bigger and could potentially explode. So that's what adding liquidity does right now. Stock valuations stretch even higher. Speculation accelerates. Leverage increases behind the scenes. Gold, silver, and commodities start rising. Real yields get pressured. Wealth inequality increases. And confidence in the currency slowly slips. And nobody notices at first because the party feels great. Everything going up, everyone is feeling richer, and every dip gets bought instantly. This is how the final ride-up usually feels. The biggest difference today is this. In the last cycles when the Fed printed aggressively, they were trying to save a weak economy. This time, they are printing to support the government's debt issue. The fiscal side of policy, Congress, the deficits, the need to issue more bonds, is now forcing the monetary side into a corner. This is also known as fiscal dominance. And once the central bank becomes responsible for keeping the government's debt manageable, the currency is the one that ends up taking the hit. History gives us multiple examples. Great Britain in the 1970s, Latin America in the 1980s, as well as Turkey in recent history. The bottom line is when the government forces the central bank to fund its deficits, the currency quickly erodes. So here's the pattern that people like you and I need to be prepared for. First comes the melt up. Liquidity floods the system and the markets react instantly. High-flying tech stocks keep running. AI valuations get even crazier. Crypto may get noisy again. Risk-taking returns, and people convince themselves that nothing can go wrong. I refer to this as the sugar rush stage. This is more about the money supply growing faster than the economy. And once inflation starts heating up again, the Fed will have no choice but to tighten, and they will be tightening into a bubble. And that's when the Jenga tower comes crashing down and the bubble bursts. Not when things feel weak, but when things feel invincible. So let's process how this cycle will likely play out. This is the stage where we need to be smart and think with our brains and not get emotional. We're all trying to make money, so participate in the upside. But don't drink the Kool-Aid. Take your profits and build exposure to real assets. You may want to avoid being over-levered in this type of environment and be prepared for volatility when inflation rears its ugly head again. Because real assets such as gold, silver, commodities, miners, infrastructure, energy, they have a long history of outperforming when money is expanding and the currency is weakening. For instance, we could take a look at the gold to S&P 500 ratio. Historically, it was a lot higher than what it is now, but it has been bumping up against some resistance. But when that breaks through, that means that the S&P is not going to perform as well as assets like gold. Their value comes from being tangible, finite, and hard. The Federal Reserve cannot print gold, it can't print silver, it can't print oil, right? These assets have to be extracted out of the ground, which make them finite, tangible, and hard. And ultimately, they're outside of the financial system. So we're living through a moment of history that many people can't say that they lived through before. We're entering a chapter that will be discussed for decades to come. A chapter where debt outgrew tax revenue, monetary policy shifted from managing inflation to managing liquidity. The central bank became a backstop for the government. Markets soared, not because of growth, but because of liquidity. And that came at the expense of the US dollar. The most dangerous part of this chapter is that everything will feel calm. The danger doesn't show up as a crash. It shows up as a slow erosion of the purchasing power, and then that increases speed significantly. The market melt-up hides the cracks until inflation shows up and the Fed has to tighten monetary policy again. So I would argue that we're not at a breaking point yet, but as you may know, we're past the point of normal conditions. And anyone paying attention knows, once the central banks start stimulating into a bubble, that means that all the dynamics that we've known before have changed. So I encourage you to be shrewd and watchful as these dynamics play out. Thank you for watching.